Thanks for the opportunity to speak today and appreciate all of you making the effort to come. Quickly on macro, our core view is that we're likely to see sustenance of sticky services inflation driven by very low unemployment rates and brisk wage growth. We think that neutral rates or normal interest rates have trended higher since their pre-pandemic levels. And that likely means that notwithstanding we should get some rate relief, we are in a higher for longer environment. We are of the view that an ascendant President-elect Trump will amplify this inflation cycle by slashing migration, boosting wage costs, cutting tariffs, which will also increase the CPI, and by reducing taxes, which will exacerbate an already shocking US budget deficit, the biggest deficit since World War II, sans the 2020 pandemic and the GFC. And we think that to tame this inflation cycle, the biggest in decades, we're going to need a harder landing. And of course, we haven't had a soft landing. You can't land if you haven't had inflation at 2%. That remains an empirical question. So we think we're going to need higher unemployment, weaker growth, lower wages to really suppress that services inflation. And this really propagates our central case, a stagflationary cycle characterised by poor growth, sticky inflation, and increasingly signs of distress at the periphery of the economy. And by that I'm talking about subprime households and subprime businesses or zombie companies. And we're already seeing the first signs of this. So what I'm showing you right now is the default rates on high yield bonds or risky junk bonds, sub-investment grade bonds, a very good proxy for private credit. We expected the worst default cycle since the GFC, and we're on track to achieve that outcome. We're also seeing this play out in Australia. The blue line is monthly businesses going bust or insolvencies, and we have the highest insolvencies in Australia in 25 years, led by construction, hospitality, retail. You open up the AFR every week, you see Bonza going down, Public Hospitality Group, Genesis Healthcare, Healthscope, all financed by non-bank lenders, aka private credit. Sobering to note that today ASIC is opening up an investigation into private credit and disclosure practices around valuations and defaults. I don't want to tar the entire industry. Obviously, there are great private credit managers like Metrics, my stablemate, 150 staff, and have been around longer than any of the other managers. But what this chart on the left-hand side is showing you is the default rates on home loans issued by non-banks, which is the blue line, versus banks, which is the green line. And we're seeing this gigantic bifurcation. Bank balance sheets are as strong as 10 men, only a very benign increases in arrears, whereas we're seeing a huge increase in defaults on non-bank home loans. Groups like La Trobe, Liberty, et al. On the right-hand side, the left-hand side chart is all home loans. On the right-hand side chart, we've just pulled out all the highest quality or prime loans, and the same story is evident. What does this mean? I don't have much time to talk. Apparently, it's only 6 minutes. But notwithstanding that silly constraint, my key kind of portfolio recommendations are, in the biggest inflation shock, the biggest interest rate shock, and one of the biggest default cycles you've seen in decades, you want to be super liquid. That liquidity gives you the optionality to pounce on opportunities. You want to move up the capital stack into the safety and security of higher ranking assets. You absolutely want to avoid, like the plague, any exposure to cyclically sensitive sectors, particularly companies that are exposed to default risks, so subprime or zombie borrowers. And you want to be mainly floating right now, but at some point you want to average into fixed rate bond exposures when that rate relief eventually materialises. How can we help? In short, the pitch would be this. We're the most active trader of Aussie bonds globally. We have the biggest team in the high-grade bond market. We've bought and sold about $80 billion of bonds in the last 6 to 7 months. We have the best performing products in the market. Our long-short credit fund ranks #1 in Morningstar's unconstrained fixed income universe of circa 100 products. Our floating rate high yield fund ranks #1 in Morningstar's short-term fixed interest universe. They're both floating rate products. Our fixed rate or long duration active composite bond fund is #1 in the composite bond universe. We use 80 mathematical models to price bonds, to find mispricings, to generate capital gain on top of yield. I'll talk about that in a moment. We have 11 traders, 15 analysts, spread between Sydney, Melbourne, London, Auckland, and soon to be Miami. and we're running about 11 billion across 36 portfolios. Our insto portfolios have returned about 27.7% at the peak over the last 12 months, and our retail portfolios after fees have done 12 to 13%. How do we generate returns? In fixed income, everyone does the same thing. They chase yield. Yield's a pure proxy for risk. And you can boost yield through three key levers: illiquidity risk, private debt; default risk, private debt or high yield; interest rate bets, duration. We don't do any of those things. Our portfolios are ultra liquid. We turn over the portfolios as much as 10 to 20 times a year. No illiquidity, no private debt, no high yield. We have no default risk. Our portfolios are A to AA rated. We were shorting Virgin Airline bonds in the pandemic just before Virgin blew up. We were shorting Credit Suisse bonds in 22 just before Credit Suisse blew up. What we do use is typically 15 to 30 models per bond to find mispriced securities paying too much interest for their risk. So this is basically a bond paying, say, 6.25% that should be paying 6%. And when that interest rate drops down from 6.25 to 6, we get a capital gain, and that capital gain augments or supplements the yield. So we're not reliant just on yield-seeking behaviour. On this chart is every bond we've sold since January 21 in the new issue market. And you can't really see much of the data, but I'll highlight a few points. The vertical axis is return, the horizontal axis is time. We make money 99% of the time on about 5.5 billion of exits. We find mispriced or cheap bonds paying too much interest 95% of the time. The typical mispricing is this number here. It's 15 basis points. So that's like 6.15 down to 6. We get that mispricing mean reverting over this number, 9 days. And that generates a capital gain of about 0.6%. I was presenting to a group the other day. Anthony Aboud, the head of Perpetual's equities team, was in the crowd. He's an old mate of mine. But he heckled me and he said, Joye, I don't get out of bed for 0.6% capital gains. But I sort of explained to Spud, which is his nickname, that we were getting these 0.6% capital gains every 9 days. So when you turn that into an IRR or an annual return, that's about 24% a year in new issues. If we now go to the US, Euro and Sterling credit markets, same slide, all new issues, about 6 billion of exits, 12 billion of trades. We make money 82% of the time, not 99% of the time. We find mispricings about 82% of the time. The typical mispricing, 7 basis points, not 15 basis points. In offshore credit, we only hold for 3 days rather than 9 days. The typical capital gain is 0.4%. That means we're getting a smaller capital gain in a third of the time, and it means the IRR is actually much higher. So it's not 24%, it's about 36%. So this is a way we can drive alpha, not beta. We're not relying on illiquidity, default risk, or duration risk to drive total returns. So how does that manifest? Just looking over the year, FY24, long short, credit returned 12.1% after fees. That's A+ rated, floating rate, daily liquidity. Our floating rate high yield fund, also A+ rated, daily liquidity and floating rate returned about 11.6% after fees. Our fixed rate strategy, the active composite bond fund, which is an ETF, FIXD, returned 8.2% after fees. The index did 3.7%. So we beat the index by about 4.5%. And our cash enhanced ETF, FRNS, or the short-term income fund, did about 6.5% after fees versus cash at 4.2. In terms of current yields, floating rate high yield, which is our fastest growing product, about $1 billion in that strategy, is currently yielding 8.1%. It's major bank bonds. They're geared up to about 66% right now. 8.1% is the same yield you get on private debt or high yield, but you don't have the default or liquidity risk of those two sectors. Long-short credits yielding about 7.4%. HBRD, the biggest active ETF on the ASX, yielding about 6.6. FIXD, 6.5, and FRNS, about 5.6. So in summary, key takeaways are, we think we're going to have a protracted or elongated inflation cycle. We do think there is a risk of higher long-term interest rates as governments have to issue a lot of debt to fund the burgeoning budget deficits they're running, and we could see some capitulation in terms of long-term interest rates. We saw this with the UK mini-budget crisis in 2022, where UK government bond yields jumped 2 to 3%. We saw this with the French fracas a few months ago when French government bond yields also spiked over German government bonds. And I think there is a risk that we could see some dislocation in terms of long-term interest rates. That means higher discount rates. It means lower asset prices for everything. So I'd be mindful of that. In the meantime, staring down the barrel of a very, very serious default cycle, we would be liquid, up the capital stack, avoiding default-sensitive sectors, and thinking about averaging into duration over time. Thank you for the opportunity to speak to you all.